Welcome everybody, this is my second video about the feature deep dive, and in this video we will talk about the volatility strategy. If you missed the first video about the price ranges, then go ahead and watch it first so you can better follow this video. In the first video we chosen a pool and the price range, and we talk about the concept of the price range and the bin step. And we decided to go bin step 20 on a pair Sol USDC. So this will be the pair where we add our liquidity to earn fees. So let's create a position and we will add liquidity to it. Let's go with $10 in USDC and $10 in Sol. And the bin step was our first decision, and our second decision will be the volatility strategy here underneath. And this is the next great feature and possibility where you can shape your liquidity within a position. So when we go here, we will see our bins, and the bins are distributed in the spot strategy evenly. So when I zoom in, we will have our $10, and you see here within the bins there will be evenly around 3 cents in each of the bins. So this will be evenly distributed, and with the Sol the same. There will be just an amount of Sol will be distributed within all of the bins evenly. This means then when the price goes up and goes down, you see this here, there's the price. So when the price go up, we will evenly use our Sol to generate fees. And this is a horizontal visualization of the actual price movement, but we can go to the chart, and this is how it actually looks like. So I think it is better when you have it on the chart, because the price can go up and the price can go down, and this is how it actually turned. So we have our, as an example, just in visualization so you better understand it, our 20 bin position, within which is around 12%. And we have our current, or let's say market price. So we always open our pool from the actual market price. So the actual market price is around $148 at the moment for one Sol. So when we go with the spot strategy, as I said before, all your liquidity, and there's both tokens in this case, so you have Sol and you have USDC, and when the price goes up, Sol will be converted to USDC, and when the price goes down, your USDC will be turned into Sol. So it will like DCA in or DCA out. Very simple. So token sits on the both sides. And with the spot strategy, you can use it for most stable pairs, not for the meme coins, because it's then more volatile, and when it's more volatile, it brings more risks. So you could be very fast get an permanent loss. We will talk about it in a second. The second strategy is the bid-ask strategy, and this is the actual shape. So in the middle of your entry, you will use less of your liquidity, which will then save you. It will be less risks. When the price goes down, you will DCA into the token, and when the price goes up, you will sell less of your Sol in this case at the lowest price. So your key here, you will sell most of your liquidity on the most highest price of this range. And of course on this range, you will earn more fees. The more liquidity you have in a bin, the more fees you will earn in this case. So this is how it actually works. And when we speak about the volatility or the price action, what drives the price the most is of course supply and demand. So this means that you need to decide where are the zones where you think that there will be a lot of volatility. So the the faster the price goes to a specific area in a short amount of time, we speak about high volatility. When the price goes like sideways, for example, and there's a less buys and sells, and in a short amount of time, then we speak about less volatility or low volatility. So when we look at the price chart, and we see that we have here something like a resistance zone, so there's a high density of the price action. That means that when we place here our liquidity in this area, we will approximately face an increasing amount of volatility, of selling, where people will sell the token because they buy it low and they want to sell it here because they think that will fall down from this level, because it is a kind of a resistance zone here. When you're a trader, you will understand. So when you're not experienced in TA, then you can use another indicators that will highlight the support and resistance zones for you. So let's imagine we want to catch a lot of volatility with the most amount of our liquidity. So this will be a great zone where we're expecting a lot of volatility, sell pressure, we can call it, and we will, with a bid-ask strategy, we will do that here. And in the sideways moves where we have not much liquidity, and so we will fetch less fees, and the rest of the beans will wait, they will be like idle. The curve strategy is the opposite of the bid-ask, so it's like inverted one, and this is good when you use it for stable pairs, for example stable coins like USDC, USDT, because they are like don't move much, and you can concentrate your liquidity in the middle of a price. Or tokens that goes sideways, for example sideways moves, then you can catch it with the most amount of the liquidity, and where you're not expecting a lot of movement up or down. And of course you can add liquidity one-sided. That means that when we go down, for example here, just as a representation, when you, for example, you wanna buy a specific token with USDC, you add USDC one-sided, and I have added here the market price. So for example, this is the current market price, and when we add it with a spot, it will be evenly distributed to the downside within the range of your range that you decided. With a 20 bin step, it will be 14%, 12% to the downside. And of course, you will buy this token evenly. That means that when Sol will go down, the price will decrease. You will, at a certain point, face an impermanent loss, where your price, your average price, will be less than the current market price, and the break-even will be around here in the middle, around 50%. And you need, of course, to think that you will earn fees that will somehow compensate your loss. And when there's a high volatility, then you will more fees, and when it's less, then of course less. With the bid-ask, you decrease your risks, so you buy less or use less liquidity to buy the token at the current market price, and you buy more and more when it goes down. So when it's on the lowest range, you use and buy with the most liquidity that you added within this pair, which is just one-sided. And of course here on the downside, you will earn the most amount of fees, and your break-even will be around here. The curve, as I said before, is the inverted version of it. So in this case, for DCA into the token, it's not the best option, because you will buy the most amount of token at the current market price, and when the token goes down, you will face a much bigger impermanent loss than when you go with a bid-ask. But You can also use it, for example, for some bounce moves. So when the token goes up and then you wanna catch it on a bounce, and when the token go up, you will earn a lot of fees, or you can sell your fees at a higher price. So in this case, you can use the curve to catch these moves, because when it go to the, let's say, to the support zone, you will farm with the most amount of liquidity. And of course, you could also use one-sided liquidity to sell a token. So when you want to sell a specific token, here the representation of the market price, and we add one-sided liquidity, we will earn fees only when the price moves up. It's logical, right? And here the same rules, so evenly distributed, and your average will be around here. With a bid ask, you sell less of your token in this case and use less liquidity to earn fees at the lowest price, around the market price, and you sell or earn the most one in the upper range. And the curve is the exact opposite. So you use, for example, you know that the token will go downside for a certain amount of time, then you can use it, for example, but you will use the most amount of liquidity at the current market price. So for selling a token, not the best option. So this is about the bid ask, curve, and spot, and hope you understand the concept even better. So in the next video, we will get and speak about the next features that we will finally create our pool.